All right, thank you very much for joining me here today. To start off, a few China stories to go through. China's security regulator vowed to prevent abnormal market fluctuations after Chinese stocks plunged to a 5-year low. But they announced no specific measures. Here's more on that.
China is ready to step in as stock markets in the country tumble. The country's blue-chip CSI 300 index fell nearly 5% last week, hitting 5-year lows. On Monday, it fell again in early trades before stabilising. The falls have come amid signs of panic selling. Sentiment wasn't helped last week when a Hong Kong court ordered property giant Evergrande to liquidate. It collapsed under the weight of some $300 billion in liabilities, and its troubles have roiled China's vast property sector. Kingston Securities Research Director Dickie Wong says there's no bigger concern right now.
So this is the key thing that affecting the stock market itself, because as we all know, the real estate market, the negative wealth effects may affect the consumer behavior and expenditure. So this is maybe one thing to drag down the economy in the longer term.
Over the weekend, the China Securities Regulatory Commission said it would step up market stabilisation measures. That includes a crackdown on misbehaviour such as market manipulation and insider trading. The watchdog also said it would listen carefully to investors' concerns and respond in a timely way. The CSRC has already taken steps to support stocks, including curbs on short selling. Those measures have so far done little to stop the market slide.
And following the collapse of China's once largest developer, Evergrande, around 20 million unfinished housing units have been left in China. And in the north city of Shijiazhuang, one buyer told Reuters he's lost confidence and didn't want to invest in China again. Here's the story.
In the northern Chinese city of Shijiazhuang, a massive apartment complex lies unfinished behind a fence. For the industrial city's 11 million residents, it's a daily reminder of the collapse of China's once largest developer, Evergrande. Construction on the Central Plaza project promised 1,800 new homes. But the project stalled in 2021 after China Evergrande Group defaulted. This 38-year-old resident, who declined to give his name, paid more than $350,000 for 2 units.
In the winter of 2017, I spent 2.5 million yuan buying 2 apartments. The project was intermittently halted in 2020 due to issues with resettlement housing and debt, leading to a complete stop after Evergrande's financial troubles became public at the end of 2021. The total sales volume of this project was around 2 billion yuan, probably affecting over 1,000 homes, although I don't have the exact figure. As of now, the main contractor has pulled out, and the project's progress is painfully slow. Despite the government's attempts to push forward, the effects have been barely noticeable, and we seem to have no other way to resolve this issue.
A government notice on the site says the project is now seeking a new developer, but that doesn't help buyers who paid in full 2 years ago and are now waiting for a lifeline. At the end of January, a Hong Kong court ordered Evergrande to be liquidated, but the process could take years. Evergrande said the company would work to finish ongoing projects despite the order. Meanwhile, China has said that the completion of unfinished homes is a policy priority. But the anonymous buyer says he's now lost faith in the company's management capabilities and will never invest in China again. Investment bank Nomura estimates there are around 20 million unfinished housing units across China left by Evergrande and other failed developers. Their report estimates the funding gap for completing these projects stands at around $446 billion. State-owned developers and local governments have recently taken over some stalled projects under a government-run policy in recent months, according to official announcements and media reports. China has not disclosed how much funding has been provided to complete those stranded developments, or the number of projects authorities have taken on. Reuters could not verify the total number of unfinished Evergrande projects in Shijiazhuang. Evergrande did not reply to a request for comment.
And China says its economy was strong and healthy in 2023, but was it really? China is cracking down on any suggestion to the contrary, erasing internet posts showing the economy, the stock market, and the real estate industry all struggling. Here's the story.
The world's second largest economy had a tough year in 2023. Now, one of Beijing's answers to the challenge, ban and erase criticism of it. In December, China's Ministry of State Security issued this order: resolutely crack down and punish illegal criminal activities that endanger national security in the economic security field. Apparently, that includes disappearing negative commentary from the already heavily censored Chinese internet. On December 1st, this prominent economic professor, Liu Jipeng, advised people not to invest in the falling Chinese stock market.
And when you click to follow him, you get this message, which translates: it is forbidden to follow this user due to their violation of relevant rules.
CNN found similar freezes temporarily imposed on at least 5 other Chinese economic analysts. Also removed from the internet, this documentary highlighting economic hardship among Chinese migrant workers.
I think the Chinese economy is at a cliff edge at the moment. I don't think it has started falling off the cliff yet, but it's getting to a point where things can get much more difficult.
Officially, the Chinese economy grew by more than 5% last year, but the country's youth unemployment rate keeps hitting record highs. Then there's China's all-important real estate sector, which, along with related industries, used to make up 30% of the Chinese economy. Across the country, protests as angry new home buyers demand completion of unfinished homes that they've already paid for. Perhaps the only other sector gloomier is the country's stock market. In the past 3 years, the combined Chinese stock market lost more than $6 trillion.
I haven't made any money out of the stock market, so I sold all my stocks.
The Chinese economy is strong, and it will be stronger, says this Beijing resident. Perhaps she got the message from this recent meeting of the country's top propaganda officials. Their order: amplify bright prospects of the economy as China heads into 2024.
And are you hosting a Super Bowl party this year? You can expect to spend a little more than last year. That's because the price of groceries are slightly higher. But what if you want to splurge and head to Vegas to watch the big game at a bar? Here's a breakdown of this year's costs.
It's often the most watched TV event every year in the U.S., the Super Bowl. Roughly 112 million people across the country plan to throw or attend a Super Bowl party this weekend, and more than 16 million plan to watch at a bar or restaurant, according to the National Retail Federation. And with Super Bowl 58 between the Kansas City Chiefs and the San Francisco 49ers being hosted in Las Vegas, you can expect big crowds and high prices in Sin City.
It's a big weekend in Las Vegas.
If you want to travel to Vegas just to watch the game at a bar or casino, here's what you can expect to pay. The average price for a hotel room this upcoming weekend is $391 per night, according to travel platform Hopper. Compare that to this past weekend, prices were $161 a night.
I don't think we're going to be able to score some great Super Bowl deals.
It will be much cheaper to watch from your couch. The National Retail Federation says total Super Bowl spending for food, drinks, apparel, and decorations are expected to reach a record $17.3 billion. That averages out to $86.04 per person.
A Super Bowl party at home is going to be the best way to get the bang for your buck.
Shoppers are still paying more for food. According to a Super Bowl food spending report by Wells Fargo, ground beef prices are up nearly 12% compared to a year ago. But the price of fresh chicken wings is cheaper, averaging $3.26 a pound. Here's a savings tip. That same report suggests canned soft drinks will cost more than bottled ones. That's partly because the cost of aluminum is higher.
Now, scoring a seat for the Super Bowl is still possible as ticket prices have dropped, but they are still the most expensive on record. The cheapest ticket to get into Allegiant Stadium in Las Vegas on Sunday is now just under $7,000, according to TickPick. Last week, it would have cost at least $8,000 to see the rematch between the Kansas City Chiefs and San Francisco 49ers. Now, on top of tickets being the most expensive on record, prices are up drastically for flights and hotels compared to the same time last year. And the U.S. Senate on Sunday unveiled a $118 billion bipartisan border security bill that would also provide aid to Ukraine and Israel. But it promptly slammed into opposition from the House of Representatives. Here's more.
A group of U.S. senators on Sunday finally unveiled a major bipartisan border security bill that would also provide aid to Ukraine and Israel after months of negotiations. The $118 billion proposal could bring about the biggest changes in the country's immigration policy in decades. However, it was immediately set upon by Republicans in the House of Representatives. While President Joe Biden urged Congress in a statement to swiftly pass this bipartisan agreement, House Speaker Mike Johnson declared it dead on arrival if it reaches his chamber, saying on social media that the bill is, quote, even worse than we expected. Despite the opposition, Senate lawmakers behind the bill are vowing to push ahead. Independent Senator Kyrsten Sinema, one of three bipartisan negotiators, told reporters the legislation would secure the U.S. southern border. It includes having Homeland Security officials temporarily shut down the border if too many migrants cross over a sustained period of time. The bill would also end the controversial practice of catch and release by speeding up the handling of asylum cases instead of quickly letting apprehended migrants go and allowing them to stay in the U.S. for years while they await hearings. Senate Majority Leader Chuck Schumer said he would try to hold an initial vote on the bill on Wednesday. The top Democrat said the deal would provide more frontline and asylum personnel and bring about faster and fair immigration decisions. Though some progressive Democrats are angry about the lack of solutions for so-called dreamer immigrants brought into the country as children. According to Senator Patty Murray, who chairs the Senate committee overseeing spending, the legislation will put $20 billion into border security. It also pledges $60 billion for Ukraine in its war against Russia, $14 billion for Israel, and almost $5 billion for U.S. allies facing aggression from China in the Indo-Pacific, such as Taiwan. Another $10 billion would go to aid for civilians in conflict zones. Top Senate Republican Mitch McConnell has supported the bill, saying his party would not get a better deal under a Republican White House.
The streak of big tech layoffs continue, with Snap being the latest to announce a 10% cut of its global full-time employees. The parent company of Snapchat said it's reorganizing its team to promote in-person collaboration and cutting about 500 jobs. Snap estimates the cost of restructuring mostly to pay out severance expenses, and it's going to be up to $75 million. This comes after 1,200 job cuts were less than 2 years ago seen. Mass layoffs continue to rattle the tech sector. According to layoffs.fyi, this year there have been already over 30,000 jobs cut from major companies, including Amazon, Alphabet, IBM, eBay, and more. And Boeing said on Sunday it's going to have to do more work on about 50 undelivered 737 MAX airplanes, potentially delaying near-term deliveries after its supplier Spirit Aerosystems discovered 2 missed-drilled holes on some fuselages. Here's the report.
Boeing faces new problems with its troubled 737 MAX jets. The plane maker has faced turmoil since a mid-air blowout last month raised fresh concern over how well the aircraft are made. Now it's found more quality control glitches. On Sunday, Boeing said it would have to do remedial work on around 50 undelivered MAX jets. That is after supplier Spirit Aerosystems found 2 misdrilled holes on some of the planes. Reuters sources say the fault is in the window frames and may be present in some aircraft already in service. Boeing says the error does not pose a risk to flight safety and there's no need to ground any jets. But work to fix the problem could cause yet more delivery delays. The aerospace giant already faced a headache after US air safety watchdogs vetoed plans to ramp up output of the MAX family, Boeing's best-selling product. Officials at the Federal Aviation Administration say they won't approve an increase until they are satisfied that quality control issues have been addressed. Any new delays will spark mounting frustration at airlines which have the planes on order. That could drive some into the arms of arch-rival Airbus, which already enjoys a big lead in the market for narrow-body jets.
And to keep up in the artificial intelligence race, Amazon has launched a new shopping assistant named Rufus. Amazon's CEO says that Rufus has been trained in the online retailer's massive catalog, customer reviews, as well as the community Q&A, and broader web information overall. This comes as the e-commerce giant announced strong revenue growth in the last quarter, $170 billion, boosted by holiday shoppers. Rufus has been launched in beta for a small group of Amazon customers in the app. Critics are worried that Amazon will use this AI to steer customers to the products that benefit the company the most, including its private label, and that they may eventually allow advertisers to influence inquiries asked to this AI assistant. And Amazon beat fourth quarter revenue expectations on Thursday as new generative AI features in its cloud and commerce business spurred robust growth during the critical holiday period. Here's more.
Amazon beat forecasts over the fourth quarter. On Thursday, it said sales rose 14% to $170 billion, almost $4 billion better than expected. Profits also exceeded Wall Street expectations. Investors cheered the numbers, sending Amazon shares up as much as 8% in after-hours trade. Its e-commerce unit saw gains after building fulfillment centers closer to customers, enabling cheaper, faster deliveries. But investors were more focused on future revenue streams, including from artificial intelligence. Cloud unit Amazon Web Services is incorporating the tech into more and more products and starting to see the benefits. On a call with analysts, Chief Executive Andy Jassy said AI would drive tens of billions of dollars in sales over the next few years. The company is pouring money into chatbot maker Anthropic as part of those efforts. That's to match rival Microsoft, which is putting $10 billion into ChatGPT maker OpenAI. Investors are also expecting big gains from advertising revenue. Amazon recently launched ads in its Prime Video streaming service, with customers having the option to pay more for an ad-free service. Not all of the company's ideas work out, however. This week it dropped a bid to buy iRobot, maker of the Roomba vacuum cleaner, amid opposition from European regulators.
Shares of New York Community Bank have plunged nearly 45% in just 2 days. NYCB resumed its descent after a one-day break, dropping more than 6%. This comes after ratings agency Fitch downgraded the bank's credit rating, and brokerage group Citigroup lowered the target price on its shares. This was on top of a surprise fourth quarter loss tied to its commercial real estate portfolio. Other mid-sized banks also took tumbles, but analysts have said that the issues with NYCB are specific to it. NYCB also kept the quarterly dividend for its preferred stock unchanged after slashing payouts for its common shares. The bank said it's building capital to handle strict regulations after buying Signature Bank last year. And McDonald's reported its first quarterly sales miss in nearly 4 years on Monday on weak sales growth at its international business division, partly due to the conflict in the Middle East. And this sent the company's shares down. This is the report.
The war in the Middle East is impacting one of the world's most well-known brands, McDonald's. The fast food chain on Monday reported its first quarterly sales miss in nearly 4 years due to weak sales growth at its international business division. The burger giant is among several Western brands that have seen protests and boycott campaigns over their perceived pro-Israeli stance on the war in Gaza. McDonald's said recently that the conflict, as well as, quote, associated misinformation about the brand, had meaningfully impacted performance in some overseas markets in the fourth quarter. On its post-earnings call, the company's CEO said that while the most pronounced sales setback was in the Middle East, McDonald's also saw business slow in countries such as Malaysia and Indonesia, as well as in France. And it's not the only American brand whose business has been affected by the Middle East conflict. Starbucks last week cut its annual sales forecast, partly due to slowing sales in the region. McDonald's U.S. business is also starting to show signs of weakness. Traffic at U.S. stores slumped 13% in October, according to Placer.ai data cited by Wells Fargo, and declined roughly 4.5% and 5% in November and December, respectively. Shares of McDonald's were down 4% in Monday morning trading.
A rebound ahead for global chip sales. Sales forecasts have jumped this year, fueled by greater demand for artificial intelligence and automakers. The Semiconductor Industry Association projects global chip sales to climb 13% this year to $600 billion. And compare that to an 8% drop in sales last year. A reduced demand for PCs and smartphones last year partially contributed to a rise in sales for so-called logic chips. This year, auto chips are expected to grow a bit, but it's the frenzy among tech giants to deliver AI-powered products and services that has triggered a surge in demand for advanced chips. That's because AI applications require large amounts of processing units strung together. And finally, NASDAQ-listed technology company Yandex said it had struck a 475 billion ruble cash and share deal to sell all its assets in Russia to a consortium of Russian investors, including a fund ultimately owned by oil major Lukoil. Here's why the sale is significant.
It's often called the Russian Google. Now, search engine company Yandex has agreed to sell all its assets in the country to a group of local investors. The deal is valued at around $5.2 billion. Yandex is Russia's largest tech firm, with businesses in search, advertising and ride-hailing. It was long viewed as one of the few companies in the country with the potential to be a global player. Those hopes were dashed when Moscow invaded Ukraine in 2022. The Kremlin has been engaged in talks for about 18 months to spin off the Russian businesses from Yandex's Dutch parent firm. But the negotiations were complicated as the firm was largely owned by Western investors. Now businesses accounting for 95% of Yandex revenue will fall wholly under Russian control. It's been bought by Consortium First, a new investment fund linked to energy giant Lukoil. The price is a 50% discount to its recent average market capitalization, reflecting a discount demanded by Moscow, which has welcomed the deal. Yandex's Dutch arm retains a portfolio of early-stage tech businesses working on cloud computing and other products.
And thank you very much for watching NTD Business. I'm Don Ma. See you soon.